Hello, it is the 28th of September, and the year is 2011, and we're going to talk about some Fibonacci upside. But before we do, I'm going to go over two different trend lines. Going to use straight lines, though, instead of the scribbly ones. And I've been talking about this trend line. Well, now that I see four hits, I'm going to pretty much make that the significant trend line. We've now had four hits. The more often you test any level, the more likely it is you take it out. We still got a little ways to go to get there, of course, because we're on the bottom end of this range. I do a parallel line. I take the exact same rate of ascent from the first when I drag it down. Where's the best level to put it? I could basically think right in here all the way to down here. I like this one better because I get two pure bottoms in here, and I also get an area that was fighting resistance after it went below it. Okay, so now we're at support for this level. Will we bounce from that? Well, we'll have to see. If we do not, then I like to do the same rate from here to here. I'm going to put down towards there, and wherever we meet up, that's where I'm expecting to find support. That's one trend line, and it's on support, and there's some more. If we take the level, say, this one in here. This is a pretty significant trend line. If we do the same thing, find the matching support level, where are we going to get? Yeah, something like this, because we get the exact bottom from this level in 2008, which was then again tested in here, which is now again tested right now. Again, same philosophy. You break through it, then we're going down to the next level. Now let's move on to Fibonacci. Fibonacci upside works within a specific range. In this case, it is between $4 and $8. And basically what this means is I'll take a number like, say, 1.618, which is the golden ratio. And if I want to get technical, I can just put it 0.33 like that. I'd take that number and multiply the difference, which is 4, and add the 4, which gives me 1047. To get additional numbers, I just simply take its previous number, multiply it again. What's 1.618 times 1.618? Well, it's 2.618, which is where I got 1447. That times 4 plus 4 is 1447. Do it again, that's 423, which is the 21 handle. Then again, that's the 685, the 31 handle. And again, the 4836 is 1109. The next one not shown on the chart is 1794. If we multiply that by the difference and add 4, they'll give us a price objective to 75.78. We know breaking through there with conviction that that's where the market should be going to, because whenever we've had confirmation on silver Fibonacci, we're pretty much at a huge success rate. Okay, so now let's go over to how this works. And I'm going to go right from the start, from here to here. So when we started in here, we're coming up to the 1047 Fibonacci level. This is an area where you're supposed to find resistance. You don't always do it, but the psychology or information that's important to note is if you don't find resistance or support where you're supposed to, expect the market to continue its direction, and a lot of times at a nice rate to the next significant level. Exactly what happened to 1447. This level comes back to support, to resistance, back to support, to resistance, higher low, breaking through. And in here, you have to be really, if you're on the ball here, you know here this thing is breaking out. The market's at like 16, you know it's going to 21. And it did. And that's exactly where it topped. And if you don't find support where you're supposed to, what happens? Yeah, go down the next level. You didn't find much here, so pretty much went down to this $8 level. It was $8.46, so just a little pierce, and the market rebounded really fast. After the market rebounded from this level, there was a significant resistance level here that got broke, found support within the same level that was resistance, and then we had resistance, a decent pierce below the $21 level. When you broke this mark in here, you can't say, oh, now we're at 21, we're going to sell off. No, although it wouldn't have been a surprise if it did something like that, but that's not what happened. Because we're pretty much in that sideways correctional phase at the $18 to $19 resistance level. When it broke it, then the next move was quickly to 31. That was a really fast move from one Fibonacci level to the second. a very small correction. And whenever you don't have resistance, or even little resistance for that matter, then you got to expect you're going to fly through to the next one. And in here, I was stating in here how confirmation was saying we're going to 48.36 because Fibonacci told me so. And that's exactly what happened. And again, this wasn't guaranteed this to be resistance, but if it wasn't resistance, the most likely outcome would have been a fast move to that 75 level and wouldn't have taken too long. But that didn't happen. So it found a pierce above 31.42 on the correction, a pierce below 48.36 on its next level of correction, and now back down to the 31.42. That's an area where you may find support, but you can use the same theology here that you did here. That is, you were pretty close to it, you're now below it, then maybe you're going to go lower, but we already have went lower too. But what do we know if this level isn't much support? That we are going to 2094, which is a level that has not been tested as resistance, has not been tested as support, since it was resistance. And those levels don't always have to. And if you take a look at the number 1000, for both gold and the Dow, they had major resistance at 1000. And when they both broke it, they kept going and never ever did find support at the level. So there's no guarantee that we have to find support here. But at the same point, it would be a move of 2 Fibonacci levels. Now, that's not going to kill a market because we went through 1, 2, within here. We went through 2 Fibonacci levels, really down to 3. We went through 1.5 now. So if it does go here, there would be a major physical disconnect. In fact, 26 is that level I've been using for disconnect. Anything below that is where it really gets huge. That hasn't happened yet. If more people get into buy and wanting to buy, then the disconnect would be increasing just because of that. But for now, if of course we look back after the fact, and let's just say if we have a move, we've already given you the downside reaction. What I'll finish off is if we do go down here, you get the fast moves after it. You probably have big volatility go down and a big volatility up move, where before it took this long to get from 20 to 31. I would expect it to be a lot quicker. Instead of having 3% moves, you have 8% moves because you're in higher volatility. Markets were extremely volatile down below here, as would the case if we did go down towards here. But if we have a move back up to 48, and we're in a situation where we'd find this would be the third test of it, once in here, and then once way back to 1980. The more often you test resistance, the more likely it is that you break. And the question is, if we have a confirmation break above this level, where are we going to next? Well, 75, 78, which is then followed by 120. And, well, I'm surprised that a lot of people are not using this, at least within silver, because this has done extremely well in picking these levels as tops every single time. Because this was hit as a top, this was hit as a top, this most certainly was, this most certainly was, this was not, but the move to the next one was valid. So the levels of these Fibonacci's have worked exceptionally well. And that's exactly why I'm extremely confused to why I never see anyone using this type of theology. All right. I'm going to say goodbye now and have yourself a great day. Bye-bye.